So we start by 11:05. So another 2 minutes, then we start. Okay. Good morning, everybody. I hope everybody's on mute. My name is Onyeka, and thank you so much for joining today's session. We are going to be very practical, and that's why I was trying to give everybody time to join so that once we start, we are on a long stretch. So we are talking about financial modeling, and I'm not doing this alone. I have two of my wonderful friends. I have Tosin Olufidipe, and I also have Joseph Adewoyin on the call as well. I'm going to introduce myself sometime during the call. We are learning about financial modeling, and it's a very important skill, very, very important, not just important, very vital for the working world. And it's what sets financial professionals apart. There are various types of financial model. There's the three-statement financial model, the DCF. There are various types, but what we'll be learning today is basic. So we'll be sticking to the three-statement financial model. And I asked a question while we're filling the form. We wanted to know your level of Excel proficiency, because it's a bit important to actually be very proficient in Excel in doing a financial model. But be that as it may, we had a lot of people at the beginner stage, some people at intermediate stage, and very few people above intermediate stage. But so that's going to drive the delivery model for today, right? So before we start, we're going to be doing some Excel warm-up just to, try and bring back, do like a small mini refresher for about 30 minutes, right? It's going to be hands-on. So if you can open the first file we sent, the first file, that's Excel warm-up, and the password for the file is Onions 2021. If you can open the first file, it's called Excel warm-up, and the file password is Onions 2021. Let me type it in the chat box. So let's open the first file. It's just for us to have a preliminary knowledge of Excel, just to warm up our Excel skill. So Onions 2021. I will be sharing my screen. I'll be sharing my screen so we can see warm up. Please, I would like to know if you have that open. The password is Onions 2021. If you have that open, can you just like a thumbs up in the chat session so I will know that. I'm going to take this off. Yep. If you can see my screen and if you have that open, let me just see a thumbs up so I know. Okay, thank you, Divine. It's really Divine that's there. Onions 2021, that's the password, and we are opening the Excel warm-up. Onions 2021 Excel warm-up. And we're going to be learning a refresher for most of us. some key Excel functions that will be needed when we are preparing the financial model as a whole. In the financial model, we're going to be using a case study. So just for us to get ourselves aligned with Excel as a tool, right? So if we are together, I think we are all together. For those that are just joining, the passwords for the Excel warm-up is onions, capital letter O, 2021. So we have a very simple Excel illustration behind, in front of us. So we have the various requirements per department. So we have the finance department, we have the admin department, and we have the marketing department. And all we're meant to do is, what is the total, right? And I'm very sure most of us are Excel gurus already. So, but I will just do it. I will do one. I will allow us to complete the rest under this section. So, basically, to sum, you can use Alt equals to. Alt equals to will sum it for you. Alt equals to will sum it for you. Then instead of using Alt equals to everywhere, Alt equals to both for every column, once you do Alt equals to once, you can click on the first formula bar and highlight everything, then press Ctrl R. I will go over it again for those of us that, please, in case you have any question, you can always unmute your mic and let us know. Let me know. So, as I said, let me put on the chat box. So I always have everybody. Yeah, so for the first one, all we did was Alt equals to. Then to drag it right, you highlight everything on this row, then press Ctrl R. Right. So if you are done with finance, we can do the same thing for admin and do the same thing for marketing. Yes, we can do the same thing for finance and do the same thing for admin. So all we are doing is, I'll go over it again, Alt, click on the first one, Alt equals to, then click Enter, alternate key and equals to. Then you highlight everything, then Ctrl R. Ctrl R will replicate the formulas across the various cells that we have. So have we done that? Have we also done for admin and we've done for marketing? You can mute your mic, so it's going to be very interactive. So I can also hear from us and know that we are following. And please, in case at any point you are lost, you can always put your question in the chat box. Myself, Tosin, or Joseph will respond to you. So have we done for admin as well? Anybody? Admin. We can also do for admin the same thing, Alt equals to, or you can highlight everything, Alt equals to. So Alt plus equals to. Alt plus equals to. The same thing for the marketing department. We're just learning sum, right? So what we're learning is how to sum things together. It's pretty basic, but it's essential for the financial model. Alt equals to, and we have that. Are we together? Please can you meet your mic and let's say. Yeah. Awesome. Please, in case you're not following, you can always draw us back. And for those that are just joining, we are using the Excel warm-up and the password is onions2021. Now, the next thing we have to do is to consolidate these budgets together. So what is the budget for finance? What is the budget for admin? What is the budget for marketing? Right? So all we want to do is to link it together. So now, the budget for finance in the first year is press equals to sign and go and link it up with this cell C13. Equals to, then click on this cell C13. So we're trying to tell Excel that Excel, this is the sum for the first year in finance, right? And to copy all other years, instead of going equals to, then go up, equals to, then go up, from the first one, you highlight everything and press Ctrl R. Ctrl R. So Ctrl R will replicate the formulas across the row. So I'll go back over it again.
Hello.
Finance. Hello?
Yeah. R, is it R for rat or I for ink?
R for rat.
Okay.
So equals to the
Hey,
finance
what's up?
department. Click on it, right? Then you highlight everything, holding your shift and your arrow
To
key.
you.
Hello?
What's going on? Where you did the breakdown, I saw it. I've not opened it though, but I saw it.
Which breakdown?
Hey, is it a love letter?
Okay. I think
It's probably on a different call.
probably another call.
Should I be afraid? Am I safe?
You can mute the person.
Yeah, okay. Because I don't have any love letter here. So we are trying to consolidate the budget. So we have done for those joining, well, we've not started, we're just trying to warm up in Excel. So we've done for finance, admin, and marketing. Now we're trying to consolidate the budget. So to consolidate it is as simple as linking it together. So finance, we click on equals to and click on where the finance box is, the total for the finance, click on it, then enter. For the admin, for the just for the first one, equals to where the admin total is, which is here, then enter. I think Temitope has a question. Then also for the marketing, we look for where it is and enter. Temitope, please. You can mute your mic and ask the question. Temi? Okay. While we wait for her, let's just continue. I hope we are together. Then I said to replicate a formula in one column across all other columns. All we do is highlight the whole column and press Ctrl R. So Ctrl R will copy the formulas across the rows. Then we're now meant to do the total of the departments. So similar total of all the departments together. So similarly to what we did in yes, there.
Sorry, is it okay to ask you to please go through the Control R thing again? Because when I do mine, it just tells me the name of the department, right? So I've done the first bit where you link the first year for each. So it's more so the replication.
So once you have linked the three of them, you just highlight the full box. You highlight finance to marketing, you highlight it with shift arrow key, then press Ctrl R.
Okay, cool. Thank you. That works.
Then finally is to total the consolidated budget, which is similarly to what we did, right? You I'll put together. You Alt equals to on the first one. Alt equals to is a shortcut for summing a particular column. Alt equals to, then similar to what we did before, we highlight everything and press Ctrl R. Ctrl R gives us the total sum, right? So I believe that we are all done with that. Those of us joining, I think Tosin has put the password on the chat box. It's onions 2021. So now, still on this sum, I will leave this number 5 for us to work in our private time, and let's go to number 6, summing up with a single stroke, right? Because this number.
Hello.
I mean,
sorry to cut you short.
Yeah.
I'm trying to edit it from my end, but it's not working. I clicked on the Excel warm-up, right?
Mm-hmm.
Are you with me?
I'm with you, Sini.
Yeah, so it came to the Excel sheet came up, but it's not editing from my end. Do I need to download it?
Yes, download the file.
Oh, okay.
Yes.
Okay. Go on. Thank you.
Okay. So, I mean, and that's why we're doing the warm-up, so that before we start the proper financial modeling, everybody could have been settled. So let's go to the number 6. I'll leave number 5 for you, but that will run through the Excel modeling course. The number 5 will be pretty easy for you to do. So for the number 6, we want to see, so we have the account departments for each quarter, quarter 1, quarter 2, quarter 3. We have the budgets for each quarter, right? And we also have the total for each quarter. So what we want to do is that for the accounting department, we want to know what is the total for the 3 quarters, and for quarter 1, across all the departments, what is the total, right? So an easy way to do it, instead of summing the columns, then summing the rows one by one, is to highlight everything, So what I'm doing is I'm highlighting from cell C73, highlighting everything, right? Then all I need to press is Alt equals to, and everything sums automatically in a single stroke. So I'll go back again. So this is what we have, or this is what you have. We have this, and we want to sum each row, right? This is the rows. And we also want to sum each columns, right? And I said an easier way to do it, instead of summing it one by one, that is summing these 3, then summing these 3, then summing these 3, right? Is to highlight everything, right? Using your shift and arrow key, then press Alt equals to, then everything sums automatically. Are we together? Temitope, your hands is still, your hands are still up. Do you have a question? Okay. So I believe that we are all together. Are we all together? Do you understand the number 1, number 2, number 3, and number 6? We'll come back to number 5.
Yeah.
We get
Yes,
to
yes.
financial model. Thank you very much. So the next formula we need to, or the next function, Excel function, we need to understand is the max and the mean function. This isn't any, I mean, this is literally very basic. So the max function returns the highest value, and the mean function returns the lowest value. It's as simple as that, right? So for example, we have the scores of these people. We have Mark, James, William, Sam, Tony, Akira, Dia, and Lisa, right? And we have their scores. I want to know who has the highest score, right? The formula is there, but I would like us to do it together, right? By ourselves. So we want to know what's the maximum value. Obviously, we know it's 100, right? But just imagine you have like a series of like 1,000 or millions of data. All you have to do is equals to max, right? So equals to max, and Excel also prompts you, right? So max, if you're following me, you see max returns the highest value in the set of values, right? Max returns the highest value in the set of values. So max, then you press the tab key, right? Max, then you press the tab key. Then now it's asking you to select the numbers. So what are the numbers? The numbers are, what you will do is to highlight from cell C8 down to the end, right? So what you have true. So you're asking Excel, what is the maximum value from cell C8 to cell 615? Then you press your enter key, right? Then it will give you 100. Are we together? It's very basic, but all these formulas are formulas we're going to use while we're preparing the financial model. So it's very important for us to have that refresher course, right? So it's very basic. We want to get the maximum value in a series of data. It's equals to max, right? Then press the tab key. Then you highlight these are the data we are looking at from 100 down to true, right? From 100 down to true, then press the enter key, then it gives you 100 as a max, right? So similarly for mean, right? Mean returns the minimum value. So it's for mean is similar to what we have for max. So it's equals to mean, right? Then the tab key, then we highlight everything, right? Then press the enter key. Then the minimum value is 25, right? Then I introduced a small complication, and the small complication is the true, right? So Excel sees true as 1, and this is going to be helpful when we're preparing the model itself. Excel sees true as 1 and sees false as 0. So how can we test this, right? So if you write true, so we have true here, right? True. Let's write false as well, right? So we have true here and I've written false down, right? So 1 plus 1 is equals to 2, right? So let's do equals to true plus 1. True plus 1. True plus 1 will give us 2. That is because Excel sees true as 1, as figure 1. While for false, right? If you do false plus 1, you will get 1 because Excel sees false as 0, right? And it's very important for us to note. So Excel sees true as 1 and sees false as 0. I will not like take too much of our time, so because we are trying to get this done as quickly as possible. Are there any questions at this point before we go to if and or? Okay, so I'm assuming there are no questions, so we'll go to the next tab, if function. So now, please, I would like us to pay good attention to this. Most of us are used to this, so there are no issues, right? But this is just a refresher for us to just get our Excel back to speed. So we are giving the names of 4 people and their scores, right? So Babatunde Shore got 45. Fowl's a good guy, got 55. Eleon Zugabo got 65. We have the names of these guys, and Apostle Loriro got 48. And we have been given a tax, and the tax is anybody that's called, I mean, obviously the pass mark is 50%. I mean, the pass mark should be 50, right? Let's take the pass mark as 50. So we want to say anybody that scores above 50. Okay, sorry. Let's say the pass mark is 51. Let's start with 51. No, let's start with 50. Sorry. The pass mark is 50. So anybody that scores above 50, pass. Anybody that scores below 50 will fail, right? So we want to use the if function, and it's just it's as simple as if you get this, give me this. If not, give me this. That's how Excel works, right? So if you get 50 or above, give me pass. If you get 50 or below, give me, I mean, if you get below 50, give me fail, right? So we use the if function. So the if function in Excel, we press equals to. Anytime you want to type a formula in Excel, you press equals to. I'm very sure most of us know that, but we'll just go over it again. So equals to if, right? Then the tab sign, equals to if, then the tab sign. Now, if you can see my screen, I hope you can see, Excel is telling us, we first put the logical test. Now, the logical test is, what are you trying to test, right? So what we are trying to test is that anybody that scores greater or equals to 50, greater or equals to 50, right? Let the person pass, right? Give me pass. If you get less than 50, give me fail, right? So we're trying to say that if this mark here, right? That is if C9, if this mark here, right, is greater than, we use the greater than symbol, greater than or equals to 50. So I will go back again. Let me go back again. So we are trying to say on this result here, equals to if, right? The tab sign. If this mark of Fowl's a good guy, if this mark, right, is greater than, right, or equals to 50, right? If greater or equal to 50, what do we want? Now, value if to, comma, value if true. So if you get or equal to 50, what do we want? We want it to write pass, right? That is PASS, right? Then comma, if it's false, we want it to write fail. That is FAIL, right? But it's very important for us to know that Excel does not read numbers. I mean, does not read text, right? So if you want Excel to read a text, Canceling it. We have to use the quotation mark, right? Double quotation mark. Let me go back again. So what we're trying to do is that equals to if this is greater than or equals to. So if it's greater than or equals to 50, give me pass, right? Pass. And for us to write our pass, because it's a text, we'll put it in double quotation, right? And write pass.
Hello?
SS.
Yeah.
We close the double quotation. Then comma. If it's not a pass, it is a fail. If you're not passing, you are failing. As simple as that. The double quotation, then fail. Then you press your equals to, your enter sign. And we see that Fowl's a good guy, passed, right? So instead of replicating the formula over and over again, we just copy it and drag it down, right? Copy it and paste it in other boxes. Are we clear? Are we clear?
Yes.
Yeah.
Yes, can you just please go over it again? Thank you.
I'll go over one last time.
Yes, thank you.
If function. The if function, I said, we're going to tell Excel, if it's this, give me this. If not, give me this, right? So is that you're a boy or you're a girl? So equals to if, right? So what is the test? We're going to say if this mark, right, is greater than or equals to 50, right? The person has passed. And Excel reads text in double quotation, right? So we put the double quotation and write pass, right? Then press the comma, right? Then it's telling us value if false. So if it's false, what should it be? If you don't pass, you fail, right? The same thing, double quotation, fail. Then close the quotation, then click enter, right? Then we show that Fowl's a good guy as passed. Then we can copy what is here and paste it down here, and the formula replicates itself. I hope we're together. I will leave this if and function, right? It's pretty, it's not as straightforward as the if function, but because of our time, so we can get to the financial model itself. But just want to teach us some basic formulas that will help us in doing what we have to do, right? So the if function, once you can start the if function, you are a go. For a basic financial model, that especially what we have to do today, you are a go, right? So I will leave the if and or if or function, but you can always go over it yourself. And if we have sufficient time, because I'm actually running out of time. If you have sufficient time, we'll go back, we go over those functions, if or and if and, right? Okay, let's just go over the if or. Let's go over the if or. Then for the if and, which one should we go for? Let's go over the if or, right? If or, the if or functions. So now we have two, instead of having one mark we are looking at, we have two. We have marks in English and the mark they got in English and the mark they got in maths. So what is the cutoff point? So we said that for you to fail, for you to pass, right, you must either pass 50 in maths or 45, get 50% in mark, 50 points in mathematics or 45 points in English, either or. Now this is not and. So if you fail English, if you get below 45 in English, but you get above 50 in maths, we still consider it as a pass, right? So you must either pass English or maths. So you must pass at one of them, not both of them. You must pass one of them. So the formula we will use, right, is if, right, with if function. Nowadays, there is the ifs function. If you have an updated Excel, there's the if function that you have to use the if or function. But just for our learning today, we'll use the if or function, right? So equals to if, then press the tab key, right? Then we're using if, well, we're combining two functions, if and or. So we'll put the if function. I will also put the or function, that is or, right? So if tab, or tab. So we're using the if function and the or function. The if function and the or function. Now, what is telling us now is that we now have the opportunity to put more than one logic test. So the first logic test is if you get above 50, right? If you get above 50 in maths, so this is score in math, that is here, right? If Fowles the good guy gets above 50 in mathematics, above 50 in maths, right? Or if you get above 45 in English, right? So that you get above 50 in mathematics or above 45 in English, right? So what the or function helps us is to put more than one test. If we're using the normal if, we're only able to put just one test. But now we're using the or, we're adding the or function to it. So we can put more than one test. So if Fowles the good guy gets above 50 in mathematics or above 45 in English, what we'll do is to close the bracket now, right? Then put the comma sign. Now we'll go back to our normal if function. If the value is true, if you get above 50 marks or above 45 in English, he passed. And I told you, if you're writing a text in Excel, we put it in quotation sign, right? Then put pass, right? Then comma. If it's not a pass, it means it's a fail, right? Then also put it in quotation, double quotation, a fail. Then close the double quotation, then enter. And we see that Fowles the bad guy is results is a pass because it's getting above 55, above 50 in maths, and at the same time, it's getting above 45 in English. And we can copy this and drag it down, copy and paste. So copy here, copy what we have and paste it down, and we'll see for the rest. I hope we are not confused. Are we together? Are we together?
Yeah, well, with
Yes.
you.
Yeah.
Awesome.
Yeah.
So finally, in the Excel warm-up, I will do one, and let's see who is the fastest finger first for the rest, right? So we'll do one together, right? And fastest finger first for the rest. And the formulas are by the side. So
sorry, for my if or there's my formula is coming back and saying I have an error there. But
okay.
I followed exactly what you said.
So let's do a formula audit. So can you see my screen?
Yes.
Are you sure yours is exactly as mine is?
If or yeah, right. See that. See this. That's these those. Still seeing error. What's going on? This pass. That's that.
What if you paste
Yeah.
your formula in the chat?
So if you check thank you very much, BC. If you check the first one, Babatunde Showore, the formula is there.
Oh, okay, okay.
Yes, so the formula is there in Babatunde Showore that is colored blue. So you can use that to check what you have.
Thank you.
You're welcome. So now we go to the growth formulas, right? So this was we're going to use a lot when we are preparing the actual model, right? So for example, they told you are selling human hair, right? And in the first year you made, let's say this 218,000, right? You will not make 218 naira in Jesus' name. And they told you that you made 218,000 naira, right? Then for the next 3 years, right, you have projected that in the first year, right, your sale will grow by 6%. In the second year, your sale will go by 7%. In the third year, your sale will go by another 7%, right? And you want to model that, right? The formula for growth rate, to calculate growth rate is, if we check the formula by year, the growth formula technique, see is the previous year multiplied by 1 plus growth rate. Previous year multiplied by 1 plus growth rate. That is, and as equals to the previous year is this, right? Then multiplied by, into brackets, 1 plus what the growth rate for the first year. This is 6% up here. We click on this 6%. Then we close the bar. We are just following the formula 1 that we have, the formula 1. Then we click on enter. And we can see that it gives us our sale for the first year. Then to see the sale for the other years, similar to what we did, we will highlight everything, highlight the other 3 years, and press Ctrl R, and we see the growth. We see the growth rate for other years. Are we together? So can we try dividend? Dividend growth is the same thing. Dividend growth. So we are given our dividend in the first year, and we said the second year dividend will grow by 9%. First year by 9%, second year by 10%, third year by 10%. Have we done that?
Yes.
Perfect. So BC has done that. Has anybody else done that? Marvin, have you done that?
Yes, I've done that.
Okay, beautiful. I hope we're all together. So I will just do it from my own end. That is equals to this multiplied by bracket 1 plus this 9%, right? Then close the bracket, enter. Then we highlight everything, Ctrl R, and voila. Then,
I want to ask,
yes, please.
if because this is just a 3 cell, 6%. I'm talking about 9. That is 6%, 7%, and 7% for the sales growth rate.
Yes.
So if I'm to, after that 7%, if I'm to put like maybe 10% for year 3, is it going to just go on like that? Because I'm trying to do it, but it's telling me it's because the Excel is protected. I'm just saying that whatever
so this sheet is protected, but
percent you put. No, I'm just saying whatever values and the percentage you put is going to formulate the values itself, right?
Yes, it goes formulate values. It's just that this sheet,
okay, awesome.
Because of the formulas in might not protect the share, because of the extra formulas that are here to get these things. That's why the sheet are protected. So for other liabilities, now you can either grow something by a percentage or grow it by a value, right? So now other liabilities is 36, right? In the historical year. Then the first year we said that other liabilities will grow by 7.9. In the second year it will grow by a figure of 6.6. So it's going by a figure this time, not by a percentage. Therefore, to calculate if it's going by is basically to add the previous year plus the current growth, right? So the previous year plus the current growth and enter, right? Then if you drag it and press Ctrl R, it shows us that we are correct. So can we use that same thing for long-term assets? Long-term assets. Now, please bear in mind that long-term assets is reducing. It's reducing. So it's not, we are not adding, we are subtracting. Long-term assets is reducing. Have we done that? Have we done that?
All right, let me see how you did the other liabilities.
So is
okay.
Previous year plus the growth of that current year. Then we Ctrl R. Awesome. So have we done the long-term asset, everybody? Can you just give me a thumbs up in the chat box so I will know that we are together? Have we done the long-term asset reduction in the? Okay, thank you. So that is this minus this. So let's also do the capex reduction. So So CAPEX reduction now, CAPEX is not increasing, CAPEX is reducing, right? And the formula for the reduction is similar to what we have, negative growth over the last year. That's formula number 3. So can we try that? Formula number 3. So that's equals to the previous year multiplied by 1 minus the growth rate. Right? Then we drag right. So are we together?
Yes.
Okay, beautiful. So with that, we have come to a reasonable conclusion of prepping our Excel skills. So we know how to use the sum function, the and function. We know how to use the growth rate functions as well, right? And that's very important. And just give us a background to the case study we'd like to do today and go into the Excel financial model properly. So if a financial model basically is a financial forecast, right? So you are into business or you are working for a client and they say, want to know how we will do, what our profit will be in the next 5 years, right? Or next 10 years, 20 years, as the case might be, right? So based on some certain assumptions, right? So we say, okay, in year 1, let's take I don't know why I like human hair, but someone is selling human hair, right? And say in year 1, right, I'm going to sell like to 20 people. Year 2, I'm going to sell to 30 people. So it's based on certain assumptions that we build that financial model, right? So basically, we are just trying to forecast what your profit will be based on some underlying assumptions that you have today, right? So that's why it's very important when you're building a financial model that your assumptions are in line or your assumptions are par, right? And as a good financial modeler, permit me to use the word, or a good financial analyst, is your duty, is your responsibility to be able to think through deeply around each assumptions, right? And in a financial model, let me share my screen. In a 3, I hope you can see my screen. Yeah. So in a basic financial model, right, we have 5 major things, right? We have the assumptions and drivers, right? Number 2, we have the income statement. Number 3, the balance sheet. Number 4, the cash flow statement. And number 5, the supporting schedules. I'll just try and quickly run through what each of these means, right? So just as I said, a financial model, you're trying to forecast how a business will be like, right? Or how the business will be like in some a particular period, right? So the assumption sheets or the assumption and drivers, it's trying to say, so for the business, these are the certain assumptions that I'm making now that are driving my my numbers, right? So these assumptions are what are the ones driving the numbers. So you don't have to pay so much attention to the numbers. You pay attention to the assumptions. Once you get the assumptions right, it's just all about building the framework, and that's what we are teaching us today. Once you know this basic framework that we are teaching you, right? Okay, BC, do you have more question? Let me just wrap this up, then I get to you. Once you know the basic framework, right, in building a financial model, right, there's no other model that would be so hard. Obviously, there are different technicalities, different difficulties that come along the way, but it's very important for you to learn the basics, the framework. And once you can learn the framework and building the financial model, it's easy busy. So BC, please, your question.
Okay, thank you, Eka. So for these assumptions and drivers, I can see the information that says historical ratios and figures which drive the forecast. But I was thinking that it's not just historical and it's also futuristic. Like the example you gave of the hair seller who is saying that in year 1, I'm going to sell 20 hairs, year 2, 40. So basically my question is, for assumptions and drivers, is it both historical and futuristic, or is it always historical?
No, it's both, right? So I put historicals, and the figures there, it's futuristic figures, right? So historicals, in case the business is existing, right? So for example, let's say Dangote sugar. So Dangote sugar, no, Dangote sugar is too established. Let's look for someone that's not pretty established. Who is not pretty established? Let's say I sell chin-chin, right? Onyeka chin-chin is coming out, to watch out. Onyeka chin-chin, right? And in the previous year, I sold 25, just 25 cartons of chin-chin, right? Then I came to meet you, BC. I want to prepare my financial statement, and a financial model to determine how I will be in the next 5 years. And in let's say 2020, I sold just 20 cartons, and you asked me for my assumption, and I told you that BC, in 2021 I'm selling 1 million cartons. Hey, you asked me 1 million cartons. They're not so aggressive, right? So what are you going to do to ensure that you get that? What are you going to do, right? Or what are the other because if you are saying you make sales of 1 million cartons, right? Your marketing cost should obviously increase as well, because for you to make 1 million, sell 1 million cartons, you have to be doing. You have to be sitting on Orioki or something just happened to you, that's only 1 million cartons. So for existing businesses, it's important for us to look at the historicals, right? To think, so how have they come, right? And how are they looking at to grow, right? But for new businesses, there are no historicals per se, right? So we're just looking at the current year. From now going forward, what do we plan to do, right? And as I always say, a plan is nothing, but planning is everything, right? So a plan on itself, right? Having that plan, having that model, it will always change. The business assumptions will always keep on changing, right? But what we want to teach us today here is how to actually prepare that shell, right? From the assumptions to the income, balance sheet, cash flow. An income statement just shows you just have to be an accountant. An income statement just shows profit and loss. This is what I sold, this is what I spent, this is my profit. As simple as that. Obviously, there are more complications to it, but in a nutshell, right? This is what I sold, this is what it cost me, and this is the profit I'm making, right? For a balance sheet shows, so we have put this amount of money into this business, right? So a balance sheet, I would like to use Joseph was source of funds and use of funds, right? So these are what we have. This is what the business has, right? And this is what the business owes, right? And if you remove what the business has from what the business owes, you get what the business is worth, right? Someone like me now, I have 10,000 naira in my GT bank account because I'm a Gen Z, right? And I'm owing 5,000 naira to somebody. My net worth is 5,000 because what I have minus what I owe is what I'm worth. Then the third statement is cash flow statement. Cash flow statement basically is, we hear a lot about profits. You see, this company made this amount of profit. Cash flow is how much cash really enters, right? There is a lot of debts, there's a lot of accruals, there are a lot of financial jargons. You hear some people, they say, this company made this amount of money and they cannot pay salaries. Why they cannot? Why can't they pay salaries? It's because profit is there from cash flow. Cash flow is what's actually, and in terms of cash now, ego, kudi, inakwada, squander, what actually enters the hands of the business. Then finally, supporting schedules, right? In order to be able to build the model, we need some supporting schedules that will help us. And of the core of supporting schedules, we have the fixed asset schedule and the debt schedule. And when we get to the financial modeling bits, we will look at it. So before I introduce Joseph will be running us through the case study that we have. This is the case study that we have. Let's open our financial model blank template. financial model blank template, three statement model blank templates. The password is Jane Doe 2021, and Jane is capital letter. I'm going to put the password on the chat box in a few minutes. So we are opening, so Jane Doe 2021. Yeah, that's the password, Jane Doe 2021. We're opening three statements financial model blank templates. Three statement financial model blank template. So this is the case study we are working with. You have been emailed, right? It's time for us to create a financial forecast, and all we have is certain assumptions, right? And they want us to create a 5-year financial forecast as fast as possible. So this is 5 minutes to 12, right? We have less than 1 hour to create a 5-statement financial forecast, right? And to run us through the financial forecast is one of my very good friends. His name is Joseph. He works with a private equity firm, right? And is a modeler par excellence, right? So just before Joseph comes up, I just want to ensure that we are all ready for him. Have we all downloaded the file? Is 3-statement model blank templates. And
I'm seeing a project watermelon. Okay, project watermelon. All right, cool.
Yes, project watermelon. I don't know why. Please, you can change the name to anything you want. That what came to my head when I think I was hungry. So Jane Doe.
Maybe because you like watermelon.
I like watermelon. It's a good thing. I mean, so for, the password is Jane Doe 2021. So give me a bit. So at the how do we get the Excel sheet? The Excel sheet was sent as okay. So let me just put it in the chat box for you. Yeah. So that's the Excel sheet. I just sent it to the chat box, so you can just So I hope we've all. Can you see my screen? Can you see my screen, everybody?
Yes, we can see your screen, Oyeka.
Okay, beautiful. So before we Joseph, so at the end of the day, when Joseph is done, this is what we're going to have. Right. So sorry, I'm sharing the blank template. Sorry, I'm going to share the completed template. So yeah, at the end of the day, right? This is what we're going to have. We're going to have a dashboard that shows the revenue trend of the business and some key ratios. And we're going to have our final output sheet that shows the income statement, the cash flow, and statement of financial position, right? Currently, what we have is something blank, and we're going to transform it to something that looks like this at the end of the day. So without further ado, let me introduce Joseph. Joseph is going to be, Joseph is going to be taking us through the financial model case study that we have. So Joseph, you can share your screen.
Hi, Oyeka, good morning. Good morning, everybody. Can everybody hear me?
Yes, we can. Good morning.
Yes, we can. Good morning.
We can.
I'm so pleased to be here, to be, talking to you guys. Oyeka already flattered me, so I guess I should just keep quiet. My name is Joseph Adewoyin. I work with a private equity firm. Let me just say I've been building models for, there are about 6 years now and counting. I don't intend to stop. And it's something I enjoy doing. So in the interest of time, I'll actually just go into the core of what we are doing today. First, we need to know that this is actually just basic financial modeling, right? So it won't be something so serious. We'll be very simplistic in our approach. You will get the gist. I can assure you will get a lot of value from the session, but largely it's not the same. I mean, you have the fundamentals, but then if you have to build something way more complex, and this will just be like a foundation for you. So I'll just leverage on some of the points Oyeka mentioned. He had introduced to you what a financial model is. He had told you about giving you a quick refresher on the most, I will call them the frequently used functions in Excel and then in financial modeling. So quickly, what is a financial model? A financial model essentially is you trying to forecast what your business will do in the future, essentially. So you're saying, I have an idea or have a business that is running, and I intend to tell you in monetary terms. I'm not telling you in terms of the impact to the society. I'm telling you in terms of cash, in terms of profits or otherwise, what my business will do in X number of years. And why do I need to build one? I'll take that from two angles. One, for yourself as a business, you need to know what your business is capable of doing if X happens, if Y happens, right? Okay, video. So I will just show my face briefly for say 1 minute. Hello, so it's not a masquerade talking to you guys. Can everybody see me?
We can see you.
I can see. All right, I don't know why I'm not looking as neat as Oyeka. Oyeka, what's happening here? Okay, saying, why do I need to build a financial model? You're building a financial model for yourself as a business, or so I'm taking this from the perspective of, say you guys are entrepreneurs or a business owner. Why do you need to build a financial model for yourself? You want to know how your business will do if X happens, if Y doesn't happen. Also for external use. For example, you want to approach, you need to start a business that needs 100 million naira for you to do it. You know it will do a lot in terms of returns. But then if you're talking to your bankers, to someone you want to get a loan from or an investor, they need to see, it's just show me the money, right? I can see all the story and see, I can hear you say all of those things, very interesting. But really, to me, it's a function of where's the money. So I need to see the money, I need to see how you're making the money. That is why you need to build a financial model. What do you need to build a financial model? Because now we're building financial models in Excel, it then means that you need to understand Excel, right? So a financial model basically is you bringing in a business idea, a business model, right? Representing it in Excel using your Excel skills. That's basically it. So I would say you need to know Excel to some extent. You need to understand the business. That's basic. And then you need to understand the business, know Excel, and then a little bit of accounting, right? Just for you to understand the concepts. Like Oyeka said, all models, and I say this, sounds like I'm generalizing, right? But all models are the same. And this is what I mean. Your income statement, cash flow statement, balance sheet, they all have a relationship. That relationship has not changed in 10 years, right? I don't think it will change in another decade. Business can make money in different ways. You can incur costs in different ways. But the fact still remains that the way cash flows and then goes to sit on your balance sheet is the same as it does. That never changes. The same way your income statement is linked to your cash flow statement is the same way. That will never change. So once you understand the concept, it then means you can build any model, in quotes. It's not for you to understand the particular business, and then you can take it from there. And then, so let's just, I think we're talking too much. You guys are probably so eager to start. I believe we got a large chunk of what Oyeka taught us during the session. Can we just signify that you guys can hear me? Or because I feel like the room is quiet.
Yes, it's so quiet.
We can
These guys
hear
unmute your
you.
mic now so we can walk it through.
Probably a guy, because I've been hearing a lady confirm since maybe
We're taking everything in, that's why we're trying to get everything.
Okay, Mr. Lucky, thanks. Okay, great. And I will just share my screen and then we can, just a moment, please, guys. Okay.
Yep.
Okay. Please confirm when you see my screen. Okay. Powered by Onyeka Ogu. Taps. All right, guys. So I remember Onyeka telling us that there are some basic parts in your financial model. There is the input part where you have your assumptions. You have your calculations, you have your statements, and then you have some other supporting schedules. That's a fact. He has not lied to you. What we have just done is, for simplicity's sake, we have made sure that all your financial statements, income statement, cash flows, and balance sheet, or like the new crop of accountants now, statement of financial position. We all have those three statements in your output sheet. And then we have the calculation sheet that contains all your workings and your schedules, essentially. And then your input sheet is where you have all the assumptions. So I'll go to our statement. Okay. Okay. So again, in the interest of time, we have gone ahead to Onyeka has done a fantastic job at, you have a template, you have all the statements are essentially linked, right? So right now it's just for us to do our calculations, and then we have a ready shell that can take all of our numbers. But then just quick introduction, this is your income statement. For those of us that are not so very finance or account inclined, this is your income statement. Your income statement essentially covers your operations. I sell bread. It tells you how much have you made, how much have you spent, how much is left to you as profit. Do you want to roll over some to the next period, or I want to give them out? Essentially, that's the summary. It's telling you if your business is profitable, ideally, right? Disregard cash, like based on what you're doing, is your business profitable or not? And then your cash flow statement, which happens to be my own favorite, actually tells you, yes, your income statement says you're making a lot of profit or not, but in terms of actual cash, this is what you have. You show me the money statement. And then the third one is saying, the one we call the statement of financial position, telling you that, see, I can see your operations is nice, you have cash or you don't, but in reality, this is the assets that is generating this income, right? And all of this asset, this is how you have financed it. Oh, I have taken money from a creditor or from a bank, or I have put in my own money. Essentially, your statement of financial position or your balance sheet tells you that. And I guess that's why they call it a balance sheet, right? These are all your assets. What is funding them? What's the back? What's backing them? So that's it. You have all your three statements. So test on your sheets. If you go to, I believe we are all familiar with the Excel environment. If you can all see my cursor, you can see I'm here. There's a place called the name box. There's also a place called the formula bar, right? Onyeka was explaining to us, if function and all of that. I think, I don't know how you want to build a model and you don't know if, and you don't know sum. maybe you can escape and, maybe you can escape or, but if they are basic, you just have to know them. And just to add to what Oyeka taught us, if you want to write any function in Excel, right now, you can go to a store, you can buy a phone and it comes with a manual, right? You don't need anybody to follow you home to tell you how to use the phone. Excel functions, they actually work that way. And that's what we call the syntax. You can all see what I'm writing, syntax. So if I come in and I say, if Excel is saying I have in my memory, I have so many functions that start with the high F. Is it if error? Is it if NA, if ifs? I want the if. So I use my tab. Your tab is that key that has two opposing arrows. So I pick my tab. Immediately you see this thing come up, right? This is what we call the syntax. Essentially, it's your manual. It tells you if you want to use this if function, this is how you use it, right? And then in a particular field that you are, right now I'm on logical test. In all of this address, in this syntax, right now, I'm in the logical test area. And then I can move, by the time I'm done with that, I move to value if true, and then I move to value false. So really, you can use any function in Excel. It's just for you to, relax, calm down, and just follow the syntax. I mean, you make a few mistakes, but eventually you get it. So yeah, enough of the talks. Let's move. We go to the input sheet, guys. If I'm going too fast, I have a tendency to be really fast. Please let me know. Are we good? Yeah.
Yes.
Again, another lady, no guy. I don't know what's going on, but it's fine. Okay, so we have our input sheets. Again, guys, financial model, we don't have a lot of rules, right? In fact, they are called best practices, meaning we are not forcing you to use them, but in your own interest, and for the fact that another person might be reviewing or checking your model, it makes sense for you to follow best practices. So as a matter of advice, there are some things you should do. It makes a lot of sense, one, for your model to be laid out in a very neat way. That way, someone is checking, they're not bored, everything is not disorganized and all over the place. It helps you to read, right? You can see we have the assumptions in different sections, right? We have the general assumptions, and then you move on to the revenue assumptions, the direct costs, and all of that. Again, there's also what we call the color coding, right? Color coding means there are some cells that would contain formulas, meaning I have already typed if so, do this, right? There are also some cells that are just inputs and they are just containing actual numbers. We call them add codes, HARDCODE, add codes. You just type it in there. It is a good thing if you actually make sure, if you try and show which one is which. Meaning if it is an a hard-coded number, put it in blue or whatever you feel. Generally, most people use blue. If it is a formula, let it be in black. All of these things, they sound really, probably unnecessary, but at the end of the day, they actually make a lot of sense. Then revenue. Okay, another rule is, maybe when we get to calculation, I'll tell you that. So already, guys, we have a template. What we have now is a template that is ready for us to use. So let's go to the calculation sheet. The calculation sheet is where we will do all of the workings. And Oyeka has done in such a way that for every input, right, you can actually see the corresponding calculation field, right? So that way it's very easy for you to follow. On the revenue side, so let's say this business, I like the name. We'll talk about how the layout later and how things are. I like the name, right? Because we are actually doing a business that is a price and quantity business, right? So let's say you sell watermelon, really. In reality, most product names are not the name of the business. So let's say you sell watermelon, and for some reason, your own watermelon is for 1 unit of watermelon, they pay you 55,000 naira. I like that business. So, right now, for simplicity's sake, we have told you this is the quantity I intend to sell in the next 5 years, right? Onyeka mentioned earlier that assumptions. I think somebody asked the question, how do you, I think that I had a bit of downtime at the time. How do I know if an assumption makes sense or not? Most of the time you will know, especially when it doesn't make sense at all. So somebody comes and says, I sell 7,500 watermelons next year. But then I look at the person in the industry that has been selling watermelons since forever. And they only sell like 5K every month, every month in the same period they are talking about. It's clear that you're saying nonsense, right? Sometimes you might want to use what we call the addressable market analysis. So you say, for example, this place that I'm planning to sell my stuff, how many people can actually, what's the total population of people around here? In that population, how many people would actually be interested in getting watermelon, right? And in all of these people, how much, considering that there are other players in this space, how much of this market can I serve? By the time you do all of that, you will start getting something reasonable. But for the purpose of this class, we already have that done. We don't have to worry about that. So we have the revenue. I will sell 7,005 in year 1, and then between that time and the next 5 years, I roll up to 8,800. However, my price would grow over time. Quick one, guys. Most people, let me say, a lot of people would actually build a model and tell you whatever has to do with cost, grow it by inflation, right? Meaning, let it move in line with inflation. It makes a lot of sense, right? I mean, it's empirical. You can actually pinpoint that it's going in line with something. But for a country like Nigeria, and again, I'm not saying it's wrong, guys. I'm just saying that I think there's a bit of
Joseph, please, can you meet Esther?
Okay, sure. Gladly. I can't find Esther. Okay, I don't have to. So, and I'm not saying that it is wrong for you to follow inflation. I'm just saying sometimes it might be too aggressive. So it'd be your call at the end of the day. Should I grow by inflation, or should I have a dedicated growth rate for some of the cost lines? They call, at the end of the day, is an assumption thing. So I am saying my price is starting at 555,000 naira a unit, right? And by year 2, it will go by 5%, essentially 5% year on year. So in my calculation sheets, guys, I believe we are doing this together. So I am,
Yes, Joseph.
If as I am doing this, you also have the sheet before you can actually follow. And if I'm going too fast, I can always go back, guys. So I mean, just to let you know, we can try and I won't be too. Yeah. So we have this layer where you have your price and quantity. We all agree that to get the revenue is just a multiplication of my price and my quantity, right? So if you want, there are so many ways to do it. Onyeka taught us one growth method, not so I will just use that, and I'll probably do it in another way. So he showed us how to do it this way. Before year 1, you have what the price is, right? So you can go to the cell. You can go to the cell before year one, all right? And just do equal to, again, equal to is what tells Excel that you're writing a formula. So equal to, I go to my input sheet and I click on 55,000, which is my starting price, right? I click that, I enter. Now, if I want to grow this 55,000 over 5 years by the growth rates that we already have, Onyeka has shown us the 1 plus R method. So you go to the next cell. So I'm in year one. If you can see now, this is year one. So I'm in year one. I go to the next cell and I do equal to my previous price, which is the 55,000, multiplied by, right? It's the same thing as saying multiply it by, let me first break it down. Multiply it by the growth rate in year one, which is 0%. To enter, right? And then you go and do plus the 55,000 itself, right? So we're saying instead of doing all of that, by simple factorization equal to the previous price multiplied by, and then you open your bracket. Open your bracket. We all know the concept of 1 plus R, meaning the price itself plus the growth rate. Right? So I do 1 plus, what is the corresponding growth rate for year one? Price growth rate for year one. So I go to input. What's my price growth in year one? 0%, right? And I close my bracket. Enter, right? Now, guys, maybe someone, can we just pick someone to my feedback guy? Okay, Onyeka, you can do that for us. So you can hear me. So I have this 55,000. I can actually just drag the way Onyeka showed us. You can, so many ways. You can drag direct. That's one method. You can scroll to the right, highlighting the first one and do Control R. Right? And then you will see that your formula has carried that 55% and has grown it by 5% year on year. Can we prove it? Yes, we can prove it. If I do the change between the next price and the previous price is 5%, right? So that's how that works. When we get to other areas, I can show you the if approach. But I just wanted to use this approach so you see, and you can marry that to what we've been taught earlier. For the quantity, we already have it there. That's, just bring it in direct. 7,005, and then you drag it across. You will notice something, and this will take us back to the best practices. All of the sheets in this workbook, they actually have the same pattern. They are consistent in terms of the years. So year one starts from 1, from I, column I. If you go to any other sheet, year one also starts from column I. All through. That's not coincidence. That is deliberate. You want to make sure that they align. That way, you can always reference any I, whatever. You can be so sure that it is your year one. Do we understand? Okay. So now for the revenues. Revenue is now just your price times quantity. Right? And then I take it across. One feedback from the house. Can somebody confirm that they've done this? Or they can hear me?
Yeah. Who else is there? Can you give a thumbs up or something so that Joseph?
Okay. Thanks, Damlari. So moving on, that's revenue. That's done. Someone can just come and say, you know what, I've been doing Excel for 10 years. I don't need to do all of these things, right? I can just do a quick, this multiplied by 1 plus my R, right? Multiply it again by 7.5, direct, right? They've done everything in one cell, one row, right? What's going on? Okay. They've done all of this in one moment. Okay. They've done everything in one row. I mean, all inside one row. But the challenge with this is, if another person wants to see this, you are probably giving it, and I'm using this example, I'm assuming that, you guys have senior guys that you're reporting to that wants to check your model and all of that. It makes a lot of sense if you have it this way. They see what is happening, right? They can easily audit your model. That's why we have it this way. Going to direct cost. The assumption in direct cost is that, so we're done with this. The assumption in direct cost is that a percentage of your revenue, and that's why it's called the direct cost. Direct costs are usually those costs that move in line with your activity level. If I sell 1,000 watermelons today, I must have bought 1,000 watermelons, right, from somebody. Or I must have harvested 1,000 watermelons from somebody. So there's a direct relationship. For some others, they are not direct, meaning you can't say for every X unit, there's a corresponding Y unit that must go in cost. That's why they call them overheads. They just spread. So for direct costs, we have 60%, right? We have assumed that this business is getting better. So their direct cost to revenue reduces over time. So equal to, the formula is my revenue multiplied by my direct cost to revenue of this amount. And then, okay, if you have this formatted in, pardon me, let's return direct cost to revenue first. I think I'm too much in a hurry. Direct cost to revenue will bring it out. My revenue itself already calculated up here, right? And then, so my total direct cost would then be the multiplication of 60% and my revenue for the period. The reason why Excel can move and carry the same pattern across is what we call relative referencing. So Excel by default works on the principle of relative referencing. If you do something on one cell, right? If you move it down or left or right, Excel will mimic that pattern across until you lock something, or except you lock something. If you don't lock anything, Excel will follow that same pattern across or downwards, however you want to move it. So that's what we call the relative referencing. So moving on, so we've done revenue, we've done direct cost. Again, most financial models are the same. The only difference is businesses make money in different ways, right? The business model is different. Costs can be different, right? But to a large extent, relationships are the same. So I think that should be, I'm saying that so you can be happy that so the moment you get the concept, it's just for you to understand every other business, you can model them. So going to salaries, and quickly, can somebody just tell me in just 30 seconds how, if you want to make salaries, you want to forecast the salaries, what are the assumptions that will go in there?
Would anybody like to help us?
Okay.
Yeah, so basically, I think you'll be looking at, do I plan to hire any new person? Okay, so I plan to sell more watermelons. Am I going to need more people to be able to package them for my customers or to transport or anything? If I feel like the same person can do, the same person doing 7.5 can do 8,800, then maybe not. But if, I need more people, then I need to start thinking about increasing salaries in the next few years.
Exactly, that's fantastic. Thanks, Divine. So the point I'm trying to get out of there is actually not about the assumptions. That's very fantastic. It's also to let you know that sometimes, or most of the times, nobody actually starts and says, I want to build a model, and then they have all the assumptions set like this, right? Most of the time, it's just you are building the model, you want to build the next block, the next line, and then you're thinking to yourself, what do I need to make to get these numbers out? So you can say, you know what, I know the number of people I would need, like Divine told us, for X number of years, and this is the cost per head for each of those people. But in this case, we are not going that granular. We already have the average cost per head, and then have the head count. So if I know the average cost per head and I know the head count, I have what I need to do the salaries. So I come in here, I link to my head count, direct, and then average cost per head. Question, I'm saying average cost per head starting is 6 million per person. The question is, do we expect that to change going forward? You employed them in 2010. By 2015, say they are still there, would that still be the same annual salary? Maybe not, most likely not, ideally not. So going back to salaries, we can say, we can use the method we use here of price and then grow it by a certain growth rate. Or let me introduce to you this approach, which is our favorite if function. I can come here and say if, right? If my year, if this guy, so I'm referencing my year. If my year is 1, if my year is year 1, right? Go into my input sheet and return, moment, and return 6 million, right? If not, I'm going back. If not, right, go to the previous year's salary, right? The previous year's salary, go there, and we'll apply the same growth pattern we used in price, and do open bracket 1 plus, go to your input sheet. We already have an OPEX inflation rate here. Go in here and use this consistent in using the same row. In terms of the growth rate, in terms of everything is in the same column I. So close my brackets. Guys, let me show you. Let everybody look into the formula bar right here. Move into the formula bar. You will see, most people struggle with this. I have opened one bracket. I opened another bracket, all right? And I close one bracket. Ideally, I should close another bracket, right? They go in pairs. If you open a bracket, you have to close the bracket. So I've said, if my year is 1, right? Can use a logical test in bold, comma. By the time I move across the comma, it's telling me what should happen if my year is 1. I'm saying if my year is 1, return the initial cost by 6 million. If not, what should I do? Go to the previous year's average salary per head, and then grow it by, this is growth. 1 plus R is growth anyway. And then grow it by my OPEX inflation. And then I close my bracket. Close. Yeah. Do I want to test? Yes, I can do that. 10%, 10%. Okay, 5%, 5%. That's it. Or again, you can follow the first approach, which seems to be the easiest one right now, and just do, I already have, maybe we should do a quick vote. Which one should we go with? You can always do that later. You can follow this approach, or we can follow this approach, whichever one works. So finally our head count, the salary will then be head count multiplied by the cost per head. If anybody is lost, please let me know. If you're not getting it, please let me know, guys.
Guys, are we together? Did we get the calculation of the average cost per head?
I got the calculation, but I need a minute to do it. So if you could just give us a minute.
Okay.
Okay, guys. We have a minute.
Can you come again, please?
Okay. You want me to use the if that we have used? You want me to explain this if function, right? Hello.
Yeah,
Yes, sir.
if you could, that would be nice.
Okay, thanks. So I could have used this approach, the same approach we used here. I could have used it. I just wanted you guys to see the if approach. So if the if approach is saying equal to, I am in column 1, in column I for year 1. I'm writing it and saying, but I should have, you know what? Yep. So I'm saying, if I want to write in one cell, again, another rule in financial modeling is whatever formula you write in one cell should be good enough for you to carry it across the other to your right. Meaning I shouldn't have one formula here and I have a different one here and I have a different one here. No. So I come in here and I say, if my year is 1, meaning in year 1, let's say it in English, guys. In year, what I'm just saying is in year 1, return 6 million. But every other year apart from year 1, grow the average cost per head of the previous year by a growth rate. And that's how it works, right? If you are earning, say, 10,000 naira today, and they say tomorrow, next month, I'm growing your 10K by 10%. It means 10% on top of that, your 10K, right? That's 11K. In another month, and they say, I want to give you another 10%. It won't be on the old 10,000. It will be on your current salary, right? Right. Okay, so that's what I'm saying. Let's read it as like English. If my year, if in the year I am, that year is year 1. If the year is equal to 1, what should happen? Just give me that head cost per head. Done. What should happen if it is not year 1? It means last year's salary, I have to grow it by X%, right? So I go back to my calculation and I say last year's salary on this, where we are now, is the cell before where I am. I'm saying last year's salary, I grow it by percentage. And we have said that.
Joseph, can you mute Joshua? Okay, thank you.
Done. So, and I'm saying, how do we grow? I say 1 plus a growth rate, which we have said in year 1 is 0%. Close brackets. You have opened bracket twice, close your bracket twice. Enter. Do we get that?
Yeah.
Don't worry, I'll leave this here. I'll leave this here. But you're not expected to leave this here in a live project, just so you can see. So that's how I've done it. That's done. Let's just move quickly, guys. And I'm going to administrative costs. Again, let me just show us. On our income statement, you have revenue, you have direct costs, you have expenses, and then from there you have all the other things. So that's what we're doing essentially. We have done revenue, we've done direct costs, we've done salaries. Now we want to do admin costs. Admin costs it's the same pattern. We have a base year amount that we are growing over time. So first, administrative cost, I go to my administrative cost. I have a growth rate. I pick it, right? And I have my admin. So I'm going back to the style Onyeka taught us. I have a starting admin cost. So I say equal to 7.5, enter, right? Now, I can just do previous year. So if I want to do year one, I'll just say previous year or base year multiplied by 1 plus. In this case, I have brought my R here. Again, guys, the reason why we're doing all of these things, we are not following one pattern, is we want you to be able to see there's so many ways you can do these things. And so you don't need to be stuck on one approach, right? Depending on how you feel or how you want to do it, you can always do things as you want. So 1 plus that percentage, that growth, I have it, I drag it across, it's done, right? And then for the other costs, in fact, you guys can go ahead and be doing this. For the other costs, same thing. What is the growth rate? Okay, we don't have a growth rate here, but it's fine. Let's use this general growth rate, OPEX, right? I bring it here, 5%. What is my starting or my base year other cost? Other cost. I'm going too fast, guys. Tell me, please. But it's the same thing we're repeating, so shouldn't be so hard. Again, last year or base year multiplied by your growth factor. Anywhere is 1 plus R, where R is that inflation, in that growth rate. So I'm saying open bracket 1 plus R. My R is already on top, right? Enter, copy across, done. I give everybody 30 seconds before we move. We are moving to another area where we'll be dealing with schedules. So I would like you to confirm that we can move along. I hope we're together.
Yeah, I'm good.
And the recordings will be
It was like
after the session. So in case you want to go back and over and over and over again.
Yeah, that's great. Okay. So guys, moving on. We are a little bit moving away from those drivers that are largely growth. Now we're moving on to depreciation. We all understand the concept of depreciation. I want to start a business. I want to start making watermelon, for example, and I'm selling about 7,500 units in a year. Say I cut it before I sell. I need something to do that for me, right? But I cannot go into my income statement and say, for year one, I bought the asset for 20 million, and then I put the whole 20 million in there. That's wrong, because that asset will serve you for X number of years, not just in year one. So it makes so much sense for you to spread that cost over time. And just to chip in, there are so many concepts in finance and account that are, to be honest, common sense, right? If you take the time to just sit down and just think about it, some of them are actually things you would get why without necessarily doing a lot of reading. Let me just put it that way. So really, for the purpose of this class, that's just the concept of the depreciation. I just want to match the assets over the useful life, over the time I will use it for. So this is a basic pattern, the basic format for most schedules. So typically you have opening, something happens during the year, and then you have the closing. During the year, you can have addition or a disposal or something, right? For the purpose of this class, we don't have disposal. We are saying I have an opening asset, I bought some assets, I depreciated the assets, and then this is the value. So quick one, guys, just on the side here. Say I bought an asset for 30 naira, right? And I want to depreciate, I want to take out 5 naira as the depreciation for 1 year. What will be my closing value of the asset? Just 1 or 2 people to tell me. Exactly, because it's more like if you've used 5 and then you're left, you can use 25 left, basically something like that. So let's start. I'll start in a different way. So your closing net book value is really the addition of your opening, your additions, and whatever charge that happens during the year. So just do your sum, right? And then if you go to the top, again, you're doing this in Excel. Excel fundamentally works on a relative referencing concept. So it means whatever you open, whatever you close with last year, and that's the reality actually, whatever you close with last year is what we have this year as my opening, right? If you cook food last night and you have all things equal, you have fish in your soup. Ideally, by the time you wake up tomorrow morning, you should have the same number of living things inside the soup, right? Ideally.
Rats could have eaten it. Rats could have eaten it.
Pardon me?
Rats.
I said rats could have eaten it.
Well, that means all things are not equal. All right, so opening, so your opening for a period is actually the closing for last period, right? So closing for last period is actually, you will see this is the closing for this period. So closing for last period would then be this guy before it. So that means opening for this period is actually the closing for last period. Do we get it? Yes. So I move that across. And now I want to add more assets, an asset or a group of assets. Again, this is a very simplistic model. We are making high-level assumptions. So we have assumed that you bought some assets, all bundled. We have that as 60 million, right? This business is just rolling out. You've not done this business before. So you brought in an asset in year 1, 60 million, right? So we say equal to, right? You don't have in year 2, 3, 4. Again, this is just a simple model. If you want to drag it across, it doesn't hurt, but nothing will come. And then we are talking about the charge for the year. So really, if I have an asset, again, I like to use examples we can really relate with. I bought, again, your fish in your soup. You have planned to eat this fish for 2 days or 3 days, and you bought 6, right? You have 6 units in that soup. Ideally, you should then do 2 each day, right? So if I have an asset that is worth 60 million and I have anticipated that I will use it over 5 years, it then means every year I'm using 1/5 of the total asset. So I can come in here and do equal to the additions, right? Divided by what is the useful life? 5. Enter. It will work, but it is a depreciation, so it has to be negative, right? Considering that we are using positive, we have said sum of everything. So anything that is negative needs to come out as negative. Assuming we are doing this equal to opening plus additions minus charge for the year. This is fine. But because we are just doing plus of everything, so whatever has to be minus needs to come out as minus. So minus, and then we have 48. Now, there's a problem with this formula. And you'll see now. By the time you drag it across, it's telling you diff error. Can anybody quickly tell me why this is happening?
Because it's moving. So you're supposed to lock your 12 million.
Exactly. So, you know, I told you that Excel works on a relative referencing approach. So what it has done is it has done 60 divided by this. So it is seeing this pattern. I and then something, one row below and one column behind. It has seen the two pattern, right? This one pattern like this. So by the time I do enter and I drag to the right, it's taking that same pattern, but the pattern doesn't make sense. Do you understand? So what I need to do is, even if I move to this, to my right, I want them to retain, I want it to retain the same pattern. And that leads us to what we call the, you can call it mixed referencing. You can actually have mixed referencing or absolute referencing. We don't want to go into detail, but for the purpose of this class, I'll tell you what we need to do here. So what happened here is that by the time we move to the right, 60 million moved to this place, right? And 5 moved to the next place. I want to make sure that by the time I move anywhere, nobody's moving, right? Everybody freezes. So I move, I go back and I say, I-38, don't go anywhere. So press your F4. If you are using, if your second function is not the active stroke. If you press F4, you will see a $sign before the high and a $sign before the 38, meaning I am locking I is representing my column. I am locking 38, which is representing my row. So it means you're going nowhere, you go nowhere. And I'll do the same for my useful life. Lock it, F4, just one F4. If you keep pressing F4, it will be changing. I just want one F4 where you have $2 signs. And then you can drag this across. Now it works. Do we understand?
Yeah, we do.
Do we understand?
Okay, just a moment, guys. So moving on to the next one, profit before tax. Let's leave profit before tax for now, because for you to do profit before, taxation. For you to do taxation, you need to know your profit before tax. We don't know that yet, so let's just leave it. Same thing for dividend. For me to do my dividend, I need to know my profit after tax. I don't know that yet. Working capital, let's leave that. And because we need revenue, okay, we can do working capital. So quickly to work, I think we've taken so much time, guys. We need to move. So working capital, just a moment, guys. I want to quickly ask Onyeka something. Mr. Onyeka.
Yes, Mr.
Okay, never mind. Let's go, guys. So for inventory is, so again, watermelon business, right? Very lucrative. But the fact remains that if I'm buying and selling watermelon, it means it's not correct for me to say if I should buy 1,000 units of watermelon today. This same today, I will sell this 1,000 units, right? It won't exactly work that way. So that is the whole, and that impacts your cash because you have paid yesterday for this watermelon. Now you don't have money in your hand, right? You have to wait till you sell this watermelon before you have cash. So it impacts the cash that you have. Same thing for receivables. I have sold watermelon to people, right? They have the stock, but I don't have the money. It means potentially I should have the money, but I don't have it. It has affected your cash. Also payables. I bought it from somebody. I should pay the person. but I didn't pay the person the money. So I have cash with me. That's a good thing, right? I should have paid him, but I didn't pay him. I've told him I'll pay him in 5 days. All of these guys, they affect your cash. And that's why it's important for you to figure them out, and then they can go into your cash flow statement. So for inventory, there's a quick formula, and I will tell you and then I'll explain it so that you don't have to cram it. It says, so usually you'll see assumptions like inventory days or payable days. So it's saying in a period of say 1 year, in a period of 1 year, I hold my stock for 25 days, like cumulative, something like that, right, across. Remember, we are doing annual model, right? Now, if I want to see, are we together? Now, inventory is a balance sheet item. I want to see what happens. It will show you what the value is at the end of the year, because we are doing an annual model, right? So it then makes sense that your inventory is related to your costs. Remember, let me break it down. Remember, I bought watermelon, right? I bought watermelon. Say in a year, I bought watermelon worth 10,000, right? And I'm saying of all these 10,000, I have held my, over those 365 days, I've held in store for say 25 days. It then means that if I want to calculate my inventory at the end of the year, it is safe for me to say, what is 25 as a fraction of my total days in a year, right? I can then say that I'm closing with a fraction of that fraction of my 10,000, meaning, let's go to inventory, equal to my 25, right, divided by 365 days, right? Remember that we will drag this formula across eventually. So I don't want my 365 to ever leave this place. So I lock it. I press my F4 and I see two double dollar signs. I close it. This ideally would give me a percentage. That's 25 over, that's 7%, right? So I'm just saying 7% of my cost of sales or my direct cost is what I call inventory at the end of the year. So I scroll up, go and look for your direct costs. In this business, we should have called this cost of goods sold. But then I didn't know we'll call it a watermelon business. So, and that gives us this amount. So it's saying I sold in a year, the cost of this watermelon that I sold in a year is actually 247, right? But 25 over 365 of that is what I'm holding as inventory. So quickly, I hope I've not made a mistake. Is this 17? I-17. Yeah, that's correct. So that's my inventory. I can scroll to the right, copy to the right. Same thing for payables and receivables. So as a rule, please go ahead.
Please, can you take the explanation for the inventory calculation again?
Okay.
Thank you.
Yes. COGS. Again, we don't have a lot of time. That's why we're rushing. There are actually so many explanations to why we can go into detail of why are we using COGS. That's cost of goods sold. Why are we using revenue? Just know that inventory is linked to the stock that you have that you're selling, right? So it makes sense for you to link it to your purchases, right? But if you don't have purchases, cost of goods sold is a worthy proxy. Same thing for payables. It is what you bought that you pay for. So it makes sense to link that to your cost of goods sold, cost of what you bought. But for receivables, it is linked to what you have sold. Receivables is on your sales, not on what you bought. So what we are now saying is for inventory, I've done inventory. I'll use the same explanation for payables. For payables, I have said that in a year, it takes an average of, in a 365-day period, it takes an average of 30 days for me to get my payment, right? So I'll go back and say that 30 days as a fraction of 365 days, what is it? So I'll come in here and I say payable days 30 over 365 days. I lock my 365 because by the time I drag it across, I don't want it to move. I close the bracket. That is giving me the fraction, right? And I'm not saying that fraction, I multiply it by my COGS, my direct cost or my cost of goods sold. Okay. That's it. It's an estimate. Olabisi?
Yes, I'm with you. Got it. Thank you.
Got it. Okay. You're welcome. So the same way you do same for receivables, but now receivables is dependent on your sales or your revenue, not costs, right? So the same approach. What is my receivable days? No. My receivable days is 10. All right. So meaning on average, if I make a sale today, it takes about 10 days before they pay me. All right. So 10 days divided by in a year. This is a yearly model. F4. I lock it. I don't want it to move. And then the reason why I'm doing it one by one is I want you to see what's going on. This one is the fraction, and then it goes into the revenue. So it's a fraction of revenue. We are estimating that revenue. Copyright. So yeah, that's it, guys. So let's move on to source and I can see. I will explain that later. Let's move on to the source and use of fund.
Joseph, can we move me, Josh? Okay.
Don't worry, done. So source and use of funds. Now, this is a new business that is just starting. Say you're building this model to give an investor or someone that wants to give you money. It wants to see, it would ask you how much you need, right? But it makes sense, it makes even more sense to him to know how you want to use the money. So if I say I want to use the money to do X and Y, how do you intend to fund it? So the question is, what we do is for use of funds, you can see use, you can see source, right? So use, I want to use the fund this way. 60 million in property, right? I want to buy some assets, property, plant and equipment, some machines and all of that. And working capital, the concept of working capital, we won't elaborate, but this is what it does. For a new business, say you have a small keke that sells a watermelon, right? Before you would be able to make your money, again, in this business that they pay you 10 days after, it means your operations in the first 10 days, you need to sponsor it yourself. The money is not coming from anywhere. So working capital is saying all the operations, I want to, the AC in my watermelon shop, because it's that huge, the lighting, everything overhead, I need to start paying for them even before I make the first sale, right? So working capital is that provision that covers that. We have that as 15 million, right? And then we are saying contingency, meaning, error in estimate. I have understated what I think I need. I'm saying 5% of that. So 5% of the total, my total estimate of my total, 5% of the sum. So I have this on Yekas alt plus does your sum. You're good. So let's move to source and use source of the fund. So we know now that you need 78.8 million. How do you want it? Do you want it in debt or do you want it in equity? Equity means they give you the money and they become a part of your business, right? So they are like a co-owner of your business. That means I'm just lending you this money. Pay me my principal when it is due. Pay me my interest periodically. I'm not interested in your business. Just pay me my money. That's it, Babalo level. We know that I need 78.7 million, and the assumption here is I want to fund 20%. I want to fund it by 20% equity and 80% debt. So I come in here, 20% equity multiplied by the total, right? I want to be able to use this formula down. So I just lock my 78. And I just do, Onyeka taught us, you do this and you do Control R, right? Also, when you have a cell and you know underneath a previous formula, you can actually do Control D. It will copy just beneath it. You can just do Control D. It will copy the formula on top and bring it inside that that cell. The same way you can come here and do Control R. You can also come here and do Control D. And because everything makes sense, 78 is still locked. 80% is still correct, so we are fine. Now, your source and use of fund, they have to be the same. If not, you're telling us somebody else needs to sponsor something that we don't know. So that's it. Do we get it? We are almost done with the assumptions.
So before we go on, Joseph, can we do a pause check? Are we together? Are we together?
Yep.
Do you have any questions? I'm seeing just Divine, Ada, Layomi, Damari. Some people are commenting. The rest of us, are we together? Fortune, Olashini,
Yes.
Loli, are we together?
Yes.
Okay, I think all of it. Okay. Good stuff. So moving on to my equity schedule. So, guys, again, another common sense coming up. So it's the same, right? If I give you equity of 10 million, if I don't collect it back, you still have my 10 million, right? Yeah, right. So it's the same schedule. You need something, anything in account. Let's start with accounts. A lot of records. You keep records, right? If something comes in and never leaves, it's still there. Something has to record it, right? That's how things balance. If not, it won't balance. So I have my schedule. The same thing we did for depreciation. So I sum everything, drag across. My opening for any year is the closing for last year. I drag across. Equity injection. And there's a reason why Onyeka has done this in such a way that you can see things follow. The next thing is actually probably dependent on the previous thing. There's a reason why. So you have equity injection. We have said that I need this 78.8 million in this split, right? Now I want to tackle equity. I want to create a schedule for equity. So I come in here, what is my equity injection? I have injected this equity. Can you see how it flows? Right? If tomorrow you inject another 23 million or whatever, can you see? That is the work of the schedule. It keeps track of everything. And in this scenario, we don't have share buyback, and the company is not buying back its shares, so we'll just leave this blank. We are good. This is fine, right? Then the last part is your debt. You have done equity. Now, the debt provider also, you are responsible to the person, right? You need to keep track of what's going on. So the same pattern, my closing is always the sum of every of you guys. Joshua, okay. Opening is usually closing of the previous period. Now, what is my addition? Somebody apart from Moye can just tell us quickly what's addition?
63 million.
Can you give me the reference?
I-70.
Thank you. Okay, so this works, right? You can see our schedule is, it flows across. Now, there's a part to debt. The equity provider, you give the guy a dividend. We'll capture that later. The debt provider is only interested in two things. Number one, pay back my money, right? Or I take over your assets or whatever collateral you have used. But more importantly is my cost of giving you money. I've given you money, so give me interest. But first, let's capture principal repayment. The agreement is that, according to this assumption, is that, where are you? Yes, is that I give you this loan at 19% per annum. So every year you give me 19% interest rate under my business, under my money, and then you repay it over 4 years. So first thing is, we have decided not to make it complicated. So just first 8 years, I have 63 million. I lock it. I don't want it to change. It's the same 63 million that I want to pay over time in this schedule, right? So 63 million, I divide by 4. I lock it again. But this is an outflow. I am paying it, right? So it has to be a minus. I bring a minus here to say it is going out, right? So if it goes out, your balance reduces. And then if you copy this across over time, you're done. But now, can you see a problem? Has anybody noticed a problem?
You said over 4 years. This is over 5 years.
But I have to write one formula that will drag, I can use across.
And you drag it and stop at year 4.
No way. Okay, no way. Again, back to the rule. Whatever formula you write it must be good enough to drag across. So we know that formula works to an extent. It just doesn't know when to stop. No break.
Okay.
So we have to put in a break. And then we use the if function, right?
Hmm.
I'll come in here. I can use the same formula. I'll just come in here and say, if I'll use two methods quickly. The first approach, I can say, if my year, right, is less than or equal to 4 years, right? That's what we said. If it is less than or equal to 4 years, it's okay to pay debt, right? Hello? Yes.
Yes.
So if it is less than or equal to 4 years, pay your debt. This is pay your debt in English. Pay principal. If not, any other year is 0. If I drag this across, I did at year 4, it still works, right? So in Excel, there are no strict rules. You could have written this formula again and say, if my year is greater than 4, direct. If it is greater than 4, do return 0. If not, return my calculation. Different formula, same thing. Do you understand? Direct, like you don't have to go by a word. So another approach is for you to use what we call the tag. I think Onyeka told us about true, false, true, false. So there's what we call the tag. There's also what we call the flag. In this case, we're using the tag or flag. We're using the flag, actually. Okay, so we'll ask Excel a quick question. Flag is something that you're asking a question and you want it to return either true or false. So I can say, is my year, is it less than or equal to 4? Lock it. Excel will say true. It is true, but it is false in year 5. I'll take it again. See this. This is what we call this is a Boolean formula, and it is what is returning my flag. So I'm not writing any if. I'm just saying if. I'm just saying year, my current year, is it less than or equal to 4? So for all the years that I want to pay back, it will return true. And then for the last one to return false. Then I can come in here. Let me copy this formula here. I can come in and just say, if I'm going too fast, guys, I can come in and say, this is my original formula, remember? I can come in and just say, this formula multiplied by this flag. Done. I've gone too fast, right?
No, that's cool.
No, that's fine.
Okay, great. And in any case, you can always you can check this thing later, right? I think it's been recorded as well. So you can use Fly, you can use now for interest expense. So I'll pick on somebody. So I gave Ada 63 million in year 1, and then she has paid me 15.7, meaning I have 47 at the end of the year. What is the interest I'm supposed to pay Ada? It is a percentage of the amount that I have given her, right? 63 million. By year 2, I can only get interest on the portion of my money still with Ada, not the 63 million again, because she has paid me 16 million approx, right? And by year 3, I can only take interest on 31 million. By year 4, I can only take interest on 15 million. By year 5, I need to get out of here. Like, I don't have any money in this business anymore, right? So the same way in your interest expense, I know you've seen so many in debt amortization schedule that are like horizontal and, you know, so many things moving on. If you understand the concept, it's actually not so hard for this kind of debt, for this kind of repayment. So we were taught max and min. So what we need to do is my opening, I multiply it by the interest rate. Right, that is the interest for that period. But there's a challenge. It works for the second year, works for the third year, and all through. But for the first year, it's wrong, because first year was when I took the loan, right? So you want to write a formula that will factor the additions in year 1. So I will go in here, instead of just doing I-82, I will say the max, I will say take the maximum of these 2 places. In year 1, the maximum will be 63. In year 2, it will be these guys, so it will work. So instead of just writing a long if and all of that, I could have written if year is 1, do this, pick this one. If not, pick all these guys. A little long, right? Just do max of this, and this. Close the bracket. Enter. See these guys, they won't change. They are all total of 17.9 million. If I drag it across, they won't change. But it has factored, it has considered my first one. Are we good, guys? Let's get quickly to the interesting part, right? Can we move, guys?
Yeah.
Yes.
Do you guys want, I was about saying, do you want to take a break? Anyone?
We didn't hear you.
I wanted to ask if you probably want to take 2 minutes, you know, just to chill. Maybe I'm going too fast. I'm stressing you guys.
No.
Okay. I believe we can go with Ada since nobody's will counter that. Okay, so let's go to our output quickly. All right. So to a large extent, we've done our calculations, apart from the ones where we'll be needing some of the outputs to calculate them, like profit before tax, profit after tax, and all of that. So let's go to our outputs. So the beauty of output is once you've done your shell the right way, it's just like plugging and playing and moving on. No big deal. So I have done revenue somewhere. Before we go, just type 20 here. If in your template, your 20 has not moved along, then there's a problem. Actually, and that's retained earnings. That's your cell I-26. So your cell I-26 is saying, this is my retained earnings for year one. What is the retained earnings I'm bringing forward? That I have retained earnings from last year, essentially, right? And we have said in any model, especially an annual model, the opening in year one is the closing in year zero or previous year. So retained earnings BF should be retained earnings CF for last year. So everybody try and do this. Go to your I-26 and do this and drag it across. So what I want to see is, by the time I type 20 here, I want it to go all the way down, and then I want you to do retained earnings carried forward all the way through. If we are there, just you're on track. So that's fine. Again, let me go to my cash flows and check if that's the same. In my profit before tax, I put in 20. Okay, it flows. It didn't flow. So cash at the beginning of the year is the closing for last year, right? So again, go to cash flows, I-56. Yeah, I-56 reference the closing for last year. Enter, drag across. If you put in PBT of 20 and it flows through, we are good. So it's good. I move to my statement of financial position. I'm just testing the template to see if it's done. For my asset, I do 20 in my PPE and I go down and it's showing me 20. That's correct because I've only put in something on the asset side. It's telling me 0 in my check, so that's fine. We're good. So I take those ones out. So our template, our shell is actually ready to use. So let's go linking. Are we ready?
Yes.
I think at this point, I will just be saying, Divine, are we ready? Is everybody want to respond?
Ngozi, are we ready? DC, are we ready? Lion, are we ready?
No. All the others won't talk to me.
Yeah.
I need to sometimes. Thanks. So I will just talk to Divine. Are we ready?
Yes, you're ready.
Okay, so revenue. We already calculated revenue in our calculation sheet. So in fact, guys, you don't have to wait for me. Revenue, just even though you probably, so we know it's flowing, right? Just keep linking until I tell you to stop. Direct costs. I have direct cost here, but direct cost is an expense. So when I'm linking direct cost, I will put a negative. I want it to come in as a negative, right? I drag it across. Guys, just keep going. Our salary is an expense to minus, and just keep linking. Admin minus, it's the same order, so it's easy. Other expense minus, drag it across. If you've done it up until other expense, stop. When you're there, Divine, please let me know.
Yeah, I'm there. Other expense.
Hi, Hada. Are you there?
Yeah, we're here. Thank you.
Okay, great. So, quick check. What is your profit after tax in year 4?
Adam, what's the profit after tax?
Honestly, I'm just listening. I'm going to go back to do
Okay,
it.
great.
Yeah.
That's
Okay.
that's fine.
Mine is 138,365,128.
Okay, yeah, everybody else can copy Divine. It's fine. You can copy your sheet.
Interesting.
It's okay. Olabisi, are you there? Is it the same value you have there?
I'm still trying to drag across.
Okay. All right. Let's move on. So, guys, there's actually there's one very huge value in this session that we want to show you guys, right? So most people that have been building models for years, there's usually one thing that some people struggle with, and it is
I think we lost.
Is he frozen? Okay.
Yes,
All right.
I think Joseph.
What did you say?
We lost you for a bit.
Have you found me? Can everybody hear me?
Yes, I can hear you now.
Okay. So I was saying that even people that have been modeling for years, right? Sometimes people just do things, and the litmus test here, the first one is, does my model balance, right? If your balance sheet doesn't balance, there's a problem, right? So what we typically do, what we are trying to show you here, I think one of the core value of this session is to show you how to build your model step by step in such a way that anything you post, your balance sheet is balancing, right? And then it then means that if you post something and it doesn't balance, you know exactly why your model is not balancing. Do you get? Versus you have posted everything and then you're looking for 72,005 that you cannot find anywhere, right? So that's actually the core. So even if you've not been following us, even if you've not been building it, you can probably just take your pen and everything, and I will just tell you what goes into what. Once you do it that way, you follow that pattern, your model will, even if you've done rubbish estimates, by the time you follow that pattern, it will balance. Your estimate is just rubbish. But in terms of the agreement of the balance sheet, cash flows, and income statement, it will balance, because that is just the rule. So just follow me. And that's why I've told you that just stop. When you get to EBITDA level, just stop. Don't do depreciation, don't do interest, don't do taxation, right? Like they would say, you get why. Okay, so let's just move. First thing, let's link. Now all our financial statements are independent, right? Let us link them, right? First, I want to link my income statement to my cash flow statement. So the first place where you do that link is your PBT, right? Or it can be EBIT, whatever is starting as your, whatever revenue, profit line that is coming from your income statement on your cash flows, on your operating activities, that's where you start from. So link, I should have done the link before, but it's fine. So I want you to do this. Your PBT, right? Delete your PBT. I want to show you something, guys, quickly. Just delete your PBT. Done. Right? So the first step is link your PBT. I should have done it before we started populating our income statement. That's why. So your PBT, link it to the PBT in your income statement. Right? Done. Drag it across. So you can jot it down. All right. In fact, okay, let me just do this. Step 1. Ika, you can just help us, write it somewhere. So one, so link income statement PBT to cash flows PBT. That's one. So we've done that.
I-32 to I-20.
Yeah, so you do in I-32, you do equal to I-20, correct? That's step one. And then, so you've done that, you've already done cash flow, that's fine. Move to your balance sheet or your statement of financial position. You have two things to do there. I now want to link cash to my balance sheet, right? So in my cash on my balance sheet, so that's step two. Step two, link cash from cash flows to cash on balance sheet. That's step two. So to do cash, in your balance sheet, you have two things. You can either have cash or you don't have cash. If you have cash, it will be in your cash area as an asset. If you don't have cash, that's what we call, say, overdrafts or revolver. So essentially, you're saying, I don't have cash in the business, but I needed cash, so I took a quick loan, an overdraft facility. So cash can be in two areas. If it is a positive cash, it will be in my cash area. If it is negative, it will be in my overdraft area, right? The formula here, I could have done equal to closing cash. Where are you? See, I-57. But if I should do this, anytime it's negative, it will also come here as negative. I don't want that, right? So what I'll do is always return the maximum of closing cash or zero. Meaning, if my cash is minus 20, in this cell, return zero, I don't have cash. Do you understand, guys?
Yeah.
Yes.
If you're not getting it, just let me know. So we've done cash. Cash is last. We have two more steps. Step 3. Link cash. In fact, I'm copying the same formula, same step. It's just that, so step 3. So this one is link positive cash. Yeah. Link negative cash here. So I'm saying the same way, the same formula you wrote here. You just write it, you just flip it. Meaning that if this guy is negative, right, return it. But if it is positive, return zero. So minimum, I feel like I may be losing people here. Are we together, guys?
Yeah, makes sense.
So this is what I'm saying, guys. Let me give you an example. So let's say my cash, let me use an example. Let's say my cash at the end of the year is 300, right? It means 300 but negative. It means it is negative. I probably borrowed from someone, right? So in my cash flow statement, it is not cash. It cannot come here. But it is an overdraft. It should come here, but not positive. It is a negative. Because we have called it overdraft, we know it is negative, right? So it will be minus mean. But let me change it. Let's say it is now a positive 300. Can you see now it's coming in here, but it's not coming in here. That's exactly what I'm trying to do. I'm just trying to say, whenever my closing cash is positive, return as a cash. Whenever you are negative, return as overdraft. I could have gone here and say, if cash is greater than zero, return it. If not, return 0. But I just use that min and max. Again, just understand the concept. If you don't get it, in the interest of time, we need to move, but just understand the concept. By the time you get the sheet, you can always go through the formulas and understand what happened. And the last part is your retained earnings. So I'm taking out the 300. The last part is retained earnings. Retained earnings is, so let me take it again. Income statement has gone into cash, right? Cash has gone into cash, into balance sheet. Income statement is also now coming into balance sheet. So retained earnings, I'll go to my income statement. So that's the last step. Step 4. Step 4. Link retained earnings. Closing retained earnings on income statement to carry on. Right? Once you've done this, guys, you can actually you can link all of this financial statement in the next 10-15 minutes and it will balance. Okay, so
Joseph,
where
it's
you
a quick
go?
one. A quick one.
Yes.
The retained earnings you just linked, did you link it to I-27?
Yes, please.
Okay.
Yes, I did.
Thanks.
Yeah. So guys, I'm bringing back my PBT. Once I bring back my PBT, in my PBT, can you see? This is my check, guys. Hello.
I'm with you.
We're with you.
Okay. Your PBT is just summation of, so you're just equal to EBIT plus interest expense, right? By the time you do that, this is your balance sheet check. Everything has flowed through, but your balance sheet is still balancing. So let's do something, guys. For the purpose of this class, let's come in here. My Excel is hanging. Let's come in here in your cell C6, right? Let's write one simple if function. If the sum of all of these guys, if it is equal to 0, or sorry, let's say less than 1, return balance sheet. Okay. So we're writing is a small if, guys. If not, say check model. So this is what we are doing, guys. The rule, accounting rule is your asset side must be equal to your liability side. And your liability side is in reality liability plus equity, right? So we're saying this is already doing asset minus liability. So it has to give us 0 because they are same. So if summation of 0 is still less than, it should be less than 1 or even 0. Ideally it should be 0, right? So I'm just putting in here a check to say this is what it is. I don't want to go into conditional formatting and all of that. I'll just leave it as balance sheet okay, or balance sheet or model not balanced. So right now our model is balanced. Recall that what we are trying to do here is we want to make sure that anytime we post something, the balance sheet balances, right? So let's say I want to post depreciation. This is the next in line, right, guys? Where is depreciation coming from? Before you have depreciation, there's an asset, right? So for every, you must have bought an asset, right? You must have depreciated it, And then when you buy an asset, you depreciate it means you must have a book value, right? Is that correct?
Yeah.
Yeah.
You bought
Correct.
it, you've used it, so you have something left. Once you understand, by the time you see depreciation and amortization, and you remember this, guys, just give me 30 seconds, please, just 30 seconds, guys.
I hope we are going at a speed that is okay to read. And
Yeah, I think if we get the recordings, it would, help. But yeah, it's really helpful. Thank you.
thank you. And the password for the completed one, I'll just drop it here so you can always refer to it. That's the completed model the final sheet that we have. I'll just drop it on the comment section. So Joseph is here.
All right, guys. Welcome back from our commercial break. Apologies. So depreciation, I must have bought an asset, I must have depreciated it. Can everybody hear me?
Yeah.
Yeah, you know.
Yeah,
I must
we
have
can.
depreciated it, and then something must be left, right? So I will do just that. So the first leg is, let me even go to, so let's pick buy the asset, right? If I want to buy the asset, it must have been a cash movement. So I go to my cash flow statement under my investing activity, right? I bought an asset. When you buy an asset, you spend money, right? So where can I see assets? If I go to my calculation, so on my PPE investing, I go to my calculation sheet. I look for depreciation. You can see addition here, right? I bring in addition. I have bought this asset, but it is a purchase, meaning money left me. I bought it, I paid something. So it will be a negative. So I drag it across. Right now, it's saying that my balance sheet is okay, right? Okay, so that's wrong. The formula is not correct here. So I would improve it and say absolute. Absolute of this. Okay. Okay. So we actually we don't have a lot of time. So when you get the model, you can actually check the formula I have in here. As we check. So now it's saying error. I have negative going through because I'm not done. So I bought the asset, right? So that's one leg. When you buy the asset, I depreciate the asset. So I go to my income statement, right? Go to your calculation, I depreciate the asset. My model is still not balancing because I still have one thing left. So what is left? I bought the asset, I depreciated the asset. What is left? Something must be left. That thing must be recorded in my balance sheet to say this is the value of the asset that's left, right? So you go to your, go here. I'm going off video for a bit, but we're still talking. So go to assets, yeah. Go to your calculation sheet. And you would see closing NBV. Yep. Drag it across. Our model should balance, but it's not balancing. So that's, are we done?
Yeah.
There's one more thing. There's just one more thing. So we've bought the asset, I've depreciated the asset, and I've put the value left in my book value. So there's one thing left in your cash flow statement, right? Let me explain cash flow statement. Cash flow statement is a statement that regularizes your income statement to tell you that I can see profit, but in terms of actual cash, this is the reality, right? So if your cash flow statement takes your PBT, it's saying depreciation is not a cash movement per se. You didn't pay anybody depreciation. It's just a provision. Bring back depreciation into the profit. So that's one part. Bring in that depreciation that already had been taken out in my PBT. But this time around, it will come in as possible. I'm adding it back. Yeah. Okay. So by the time I put it back, no, it's saying negative. By the time I put it back, my model should balance. My model is not balancing. Guys, hold on. My model is balancing, but if absolute is not, it's just this my formula. It's less than 1. So my model is suddenly balancing. Guys, I take it again quickly. We have done addition of the assets, right? We bought the asset for 60 million, right? We depreciated 12 million income statement. And then we're saying we have 48 million left. And I'm now saying that last thing is I bring in I adjust my cash flow statement. I add back my depreciation, right? So I do depreciation. Now my model balances. Do you get? So the reason why we are doing it this way is, guys, the reason why we are doing it this way is, if this doesn't balance, I know I have not sorted depreciation, right? So I will never leave this place. Do you understand? I can pinpoint the problem, that the problem is depreciation. Once I solve it now and I move on, if my model doesn't balance, I will not go and check depreciation. I will not go and check assets because I know that one balanced when I did it. Do you understand, guys?
Yes.
Divine.
Yes, sir.
Yes, I
Yes.
understand.
Okay.
Yeah.
Now, so you've done depreciation, you've done assets. Somebody should pick something else. Let's say, okay, we have interest expense. For interest expense, so this is for depreciation. I'm saying these are all the things. For interest expense, what are the things you think are attached? Just tell me. Anyone? For me to be saying I'm paying interest, what would have happened?
Somebody gave you loan.
Maybe you
Or
took
you
a
took
loan.
a
Must
loan.
have taken a loan. So you took a loan, right? And then because you've taken a loan, you will pay back principal, Abi.
Yes.
There are periodic principal repayments. So that's repayment. Also, you will pay interest, right? And when you pay interest, something will be, because ideally, you probably not pay all the loans in the first year, right?
Yes.
So it's own book value as well. Like what's left? Balance. Book value or balance. So now for us to do this interest, I have to do all these 4 things. And I know where to get them. I take a loan, it's a cash loss. Money will come in. Money comes in. I repay, it's also a cash loan. Money goes out. I pay interest, it's also cash loss and also income statement. So I pay interest in the cash. I also put interest expense in interest in my income statement. And then the book value, what is left after all of these things, goes to my balance sheet. Once you do all of these things, after all of this, balance sheet balances again. Maybe we'll have to, again, the same way we adjusted for depreciation, we might have to do that. But so let's start. We take a loan. Remember, this is what led to all of these things. We saw interest expense and we felt, you know what, let's do everything that relates to interest expense. So we'll go to our cash flow statement.
I think we lost
I
Joseph.
think we've lost him.
You didn't lose me, oh.
Yeah, back now. You're using group, that's why.
You should stop losing me, oh, please. Okay, guys. So the first step will take a loan, right? A loan you are taking is a financing activity. You are using the loan to finance your business, right? So we'll take the money, go to proceeds from long-term loan, go to my calculations. It is the same thing as my addition, right? Money comes. So as far as we are concerned, I have fixed one. I have taken the loan. Number two, I start repaying principal. So you will see repayment of long-term loan or principal. So I come here, same schedule. I am paying a principal of 15.7 million. You put it in, drag it across. You've done step 2 for that in the series of steps there. The third one is I took a loan, I repay some, I also pay interest expense, right? So you can either link it here. So interest expense, the same schedule, I pay interest, so it's an outflow, minus interest expense, I paid, done, right? See, watch this space. My model is still not balanced, Abby. Let me even say, let me call it something strong. Error. Okay. So I've done 2 or 4 things. I mean, 3 or 4 things. I've done interest expense on my cash flows. I should do interest expense on my income statement, right? Yes. So I go to interest expense. I do that as well. I still have error because there's one last thing I have not done. I have missed. So I've taken a loan. I have repaid some principal. I've repaid interest. What's left? So I go to my balance sheet and I say my long-term loan, what is left is my closing balance. So it didn't balance. Why? I'll tell you why. So the same way we did depreciation on our cash flow operations. So let me just break it down. Let me explain one concept here. And maybe I should throw it to the house. If I want to pay interest, guys, is it an operating activity, an investing activity, or a financing activity? Don't rush. It's a function of the business. But
Joseph.
or did you lose me?
Yes, we lost you.
We lost you.
Okay, you found me. So I'm saying that the same way we adjusted for depreciation, right? Hello.
You are with you.
Yeah, we can hear you.
We can hear you.
The reason why that is our model is not balancing is because we have double counted. I will explain. We have said that we paid interest expense of 11.79 million here, right?
Yes, we did. Okay, so I don't know what's wrong with Joseph's network. Joseph. Okay. So I think he's back. Joseph, are you back? Or are you coming back?
Hi guys.
Yeah.
Hi, Joseph.
Sorry. So this is the first time you guys lost me, actually.
We've been losing you.
Joseph, please, can you check
Okay,
your
guys.
chat?
Oh, sorry about that. No. Where are you? Yeah, I can't see my chat. What's going on? Okay. Everybody can guess what you did, though. Oyeka.
Yes.
Okay. So moving on, guys. Operating activities. So you're saying the model is not balancing because I am saying that I have paid interest in my financing activity. But the fact is, also in my operating activity, I have paid interest. How? I am starting with profit before tax here. And before I get to PBT, I must have paid interest. So that's double counting. So what I need to do is to adjust for that interest, right? So I come in here, I add back. So it's like saying you are reclassifying. Interest expense is already in my operating activity. I have posted it in financing activity. It then means you have to add it back on operating activity. So I had it back. So I do equal to interest expense, that, and then I drag across. All of a sudden, my model is balancing. Do you get? Yes. Okay, quickly, we move on. Taxation. Let's just write a quick formula. If let's just write it here. We don't need to. We can go to calculation sheets. Let's just go to calculation sheet quickly. Calculation sheet. We have profit before tax. I just link it directly. PBT. Drag across. Now, what is my tax provision? Anytime, the assumption here is anytime I make a profit, pay tax. So I will say if my profit is greater than 0, return my profit. If it is not, return 0. So this will always return a positive PBT, right? Now, this positive PBT, multiply it by my tax rate. Tax rate is, where are you? Okay. My tax rate is 32%. I put it in, I lock it, F4. So I have 30 and all of that. So I link it to my income statement minus is an expense, is going out. Yeah. Let's quickly do same for dividend. Go to my calculation sheet. What's my PAT? My PAT is 65 million. Again, the other assumption is as well, if my PAT is greater than 0, return it. If not, return 0. So this will always return. If not, return 0. So I will then multiply this by my dividend payout. So dividend payout, guys, quickly is just a company policy. So you can say, you know what, I'm paying 20% of my profit to my shareholders at the end of the period, depending on what works for you. So output, again, I link it. Sorry, guys, I'm moving really fast now, but nothing so serious now. So yeah, income statement is complete, but now my model is saying, okay, I'll take out dividend. My model is not balancing because I have done tax, right? If I have done tax, I should also do tax everywhere else. If I'm making tax provision in my income statement, I should also do it in my cash flows. So I link it to my cash income statement, and voila, it's balancing again. So that's it again. So you do tax for taxation. Sorry, my model is now so rough, but just for you guys. So you do tax, tax, income statement, cash. So dividend, I'm doing dividend now. So I've done dividend and it's saying error. Why? Because I've done dividend on my income statement. Let me go and do it in the cash flows. So let's say the same dividend I declared, I made provision for in my income statement, I'm also paying same. So I can link it directly to my income statements, paid it, the balances again, right? So you then realize that your model is balanced every step of the way. Your income statement, you're already done. So what you have left is, as far as income statement and all the sheets are concerned, you're done. What you have left now is just the cash flows and your balance sheet, right? And really, what are the things we don't have? Share capital. Let's just do share capital quickly. For share capital, what are the things that will be involved, guys? Share capital. That will be inflow. I got money, right? Cash flows. And then there will be a balance somewhere to say, this is my balance. This is what I'm closing with. Right. So that's balance. That's it. So my inflow is in financing activity. I bring in share capital. Go to your calculations. Guys, you can speak up if I'm going too fast. Someone, please.
You
Well,
are?
listen, yeah.
You are.
Okay. I'll calm down. Divine,
Yeah.
fast, yeah?
Sorry?
Am I fast? Too fast?
Yes. Yes, you are.
Then I'm fast. So share capital. We all got it to up until share capital, right? Hello?
I mean, right now I'm still doing dividend, but should we
The
don't?
dividend is just straight, just do income statement.
Yeah. We're just linking it.
If it's giving you problem, you can leave it. If you don't post it in your income statement and you don't post it in your cash flows, your model will balance. So you can just leave it if that's the case, right? I think at this point, we can just try and follow. You will still get this, you still get the video or the audio or something. So share capital, saying I get this amount, this is equity injection. So it has come in, it's an inflow, and then my model is not balancing now. So I have to go to my balance sheet to say, when it came in, what's now the balance? So if you go to your share capital, you link it to the closing balance. Right. Once you do this, your model balances. Are you getting it, guys?
Yes.
Hey, mommy.
Just one more thing. The only reason why your working capital will not scatter your model is if you already factor the changes. Hello?
I will teach you, sir.
That's the last thing. That's the last thing.
Nice meeting you. Bye. This is serious. Why do you always look at me?
So can you
What am I muting this?
Temi
What am I
Tope,
muting?
look at me. Please, can you mute Temi? Again.
I'm actually looking for Temi.
Okay. She has gone off.
Okay. Okay. So working capital is the last one. We can actually just do, if you can link it directly, but then you have to factor the changes. That's the last bit. So let's go to calculation sheet. So this one is a little bit, you need a bit of explanation here, just quickly. So guys, I asked a question. If today I sold to Onyeka is owing me 10 naira, right? And then as at the end of this year, Onyeka owes me 10 naira. And then next year, Onyeka owes me 20 naira. Is it good for me or bad for me, cash wise? Cash wise.
Come
Don't worry,
again,
this is-
sorry.
So let's say last year,
Mhm.
when I'm closing my books last year,
Mhm.
Onyeka will be 10 naira.
Yep.
That's my receivables. Now this year, Onyeka is now owing me 50 naira. Cash wise, is that good for me or not?
No.
Let me write it here.
Wow.
So it owes me
It's bad.
10 naira now, 10 naira now, and now he owes me 50 naira.
Yeah, that's bad. That's an increase. That's bad.
It's bad. So
Yeah.
it means he has managed to take 40 more from me, right? So I want to show you a concept so you won't have to cram it. So it means it's bad. So looking at this is already bad. You already know that this is bad. So it is a negative. How do I minus 1 from 1 here that to give me negative?
Mhm.
Right?
Yeah.
I have to do previous from present, right?
Mhm.
Now, but let's use payables. I owe Onyeka 10 naira last year.
Mhm.
Same 10 naira. Sorry, Onyeka's friend. I owe Onyeka's friend 10 naira.
You owe me now. Don't
And
don't
now
owe me again.
I can't owe you and still be owing
Oh,
me.
you
You
mean,
offset.
yeah.
So I owe Onyeka 10 naira last year, and Onyeka's friend 10 naira last year, and this year I hold a friend 15 naira. So I've managed to collect 40 more, right? In my own books, that is cash wise, that's all right.
Yeah.
It means last year I should have started with 10, but now I'm even holding 40.
Mhm.
So that is positive.
Mhm.
So that is 50 minus. So in case some people will tell you for inventory and receivable, inventory and receivables, do last year minus this year. For pay, do this year minus last year. I'm saying, yes, that's true. But if you ever forget, understand this concept.
Okay.
Understand? That's what we want to do now. So for inventory, we want to see the changes. For inventory, let's open bracket. Inventory, we are saying last year minus this year, close bracket. Let's do for receivables, same thing. Last year minus this year. But for payables, it's the other way around. This year minus last year. So these are the changes. These are what the changes that happened. These are the working capital changes, right? So I can go into my, I can go into my output sheet, in my calculation. No, output. Inventory, I can put these changes here, or I do it again. For inventory, I'm saying last year minus this year, right? Can you see my model is already error? Receivables, I'm saying also, okay, I've done inventory. Let me pass inventory. So I'm going to look for inventory to follow our pattern. Go to inventory on your balance sheet and put inventory balance. Your model should balance, right? So I've done inventory balance, I've done inventory changes, my model balances. Let me go and do receivables. So I was also going to do receivable balance. What was it? This? My model will not balance because I also need to do the changes. So do the receivable balance on balance sheet. Go to your cash flow statement and do the changes, right? Previous minus current. Drag it across my model balances. Are you getting it?
Yeah.
Hello?
Yes. Yeah.
This is the last thing, guys. For payables, I say payable balance is this. My model is not balancing again. Then I'm going to do the changes. Payables changes. But for payables, it's the other way around. Current minus previous. If you ever get a mess up, you don't understand why, just follow that concept. Guys, your model has balanced. You have done a full financial model, step by step, balancing all the way. It's, to be honest, it doesn't get any, in terms of the linking, it doesn't get any harder than this. It's very, very straightforward. Again, just quick recap. Anything, first thing, post your income statement up until earnings before tax. So don't do depreciation, don't do interest. Link your income statement to your cash flows. How? Link it in the PBT. Then link your cash flows to your balance sheet. How? Cash overdraft. And lastly, link your income statement in terms of the retained earnings to your balance sheet retained earnings. Once you do all of that, all the three statements are linked. Once you are done with that, the only thing you just need to do is for anything you post, think about the implication. Interest and depreciation, what is the implication? I must have bought an asset, I must have depreciated, and therefore I must have a balance. You put all of those guys through income statement, cash flows, and balance sheet, your model balances. If it doesn't balance, you're not done with that level, you don't move. Right? Once that balances, it will never cause a problem. Move on to the next guy, interest expense. For me to have interest expense, I must have taken a loan, I should be making a repayment, I should be making an interest repayment, and there should be a balance at the end of the year. I mean, until I pay it off, right? So you put through all of those entries, income statement, balance sheet, cash flows, the balance. The only thing that can throw you off would be your interest expense and depreciation adjustment on your balance sheet, on your cash flows. Because, let me take it again, 1 minute. Interest expense, you've already taken it. When you bring in profit before tax, you have already taken out interest expense, right? So if you go to your financing activity and you take out interest expense again, that's double. You're double counting. So you have to go to your operating side and adjust it. You add it back. Depreciation is not a cash item, you add it back. Once you do that, you're good. You do taxation, pay tax in income statement, pay tax in cash flows. Dividend, pay tax in income statement, pay dividend in income statement, pay dividend in cash flows. By the time you do all of that, guys, it will always balance. It will always balance. I don't know, do you have any question, guys? Any question? Okay, no questions. I believe we have a dashboard. Let's see what we have. Okay, because this has been pre-populated, your dashboard is already picking from the right places, and you have, it's always good to have something pictorial like this to show your audience what's really going on without them having to go into your model. So yeah, that is it. Questions, guys? I think we dragged longer than expected. Apologies for that, guys. Questions, please.
None from me, except me, maybe, this your own sheet. Can we get it somehow? I think that question should be for Onyeka, because of all these comments that you made by the side, so that we could just have them.
Okay.
Yeah.
You have the completed one already, but it's without the comments, the notes.
Comments.
Yeah. So what I'll do that after the session, I'll also share the comments as well, like the
Okay.
broken down, so you can follow it as you're using the model.
All right. Thank you.
Yeah. So one quick would I say a quick comment. I think we said it also at the beginning. This is the basic that you need. If you have this knowledge, if you are very smooth with this, trust me, you can actually tell anybody you can build a model, right? You can only, it's just a case of, I've not built so many models, right? But in terms of the concept, if you get this concept, you can do what we have done here, you can say you can build a model. It's just that you've not done a lot of complex, there can be complex assumptions, There can be complex schedules, complex movements, and all of that. But in terms of the fundamentals, how they link, how you do growth and all of that, this is it. It doesn't get any harder. Yeah.
Interesting.
Thank you so very much, Joseph. Thank you so very much for
Yes. Sure.
yeah, for such an insightful session. I hope we have learned a lot. I myself, it was a very good refresher. Thank you so much. In case you have any further question as you're practicing and stuff, right? You can always go to onyekaogu.com/contact. My contact is here, and I can also give you that for Joseph as well. So you can contact us. And we'd also like to get some feedback from the session. So I have dropped the link. So please, it will be really nice if we can get feedback from this session, so we'll know how far we went today and how we can make it better for subsequent times. Thank you very much. Thank you everybody for joining. Thank you, Joseph. Thank you, every single person. Yeah, and for Buddha, we heard their voice. And Buddha will not hear their voice. So thank you. I'm just succulent. And for the completed model, I think I've said it before. The password for the completed model is Yomi19. Let me just put it in the chat box. Is Yomi19 with capital letter. Yomi. Joseph.
Yeah, I actually just wanted to say thanks for having me. Thanks for the responsive audience, especially Divine, Olabisi, Ada, and last there's a baritone that I kept getting once in a while. I think that would be I can maybe drop off. Yeah, lie on me. Thanks, lie on me.
Joseph, you can check your chat. So as just in less than 30 seconds, 1 minute, when this I just need Joseph to check his chat before we officially end the session. Just a minute, guys. Just 30 seconds, guys. Have you seen it? Okay.
Sorry, guys. Just a moment.
Yep. Okay. Thank you very much, guys, for a very wonderful session. We hope we learned a lot. Is there another addition? Right. That will be based on your feedback. So that's why we really need your feedback concerning this session, and we'll know how we'll go further, because there are still deeper depth. I say deeper depth. There are still depth into this, right? And further complications. And yeah, so if you'd like to have another session, please let us know in the feedback link that was shared. Thank you very much, guys. It's a privilege to have you. God bless you, and see you next time. Bye.
Amen and amen.
Thank you.
One of my nice songs by Chiki. Bye, guys.
Bye.
Bye.
Joseph,
Thanks, Oyinka.
Esther.
Thank you, guys.
Esther, go away.
Look at this, I'll catch you.
Bye, guys.
All right.
Now.
Baba, you see.
Yeah. Ngozi, thank you.